We are at all-time highs, and yet there are still plenty of good undervalued dividend stocks to find in this market. In this video I will give you 5 undervalued dividend stocks that are worth considering, and I will save the best for last. Stick around until the end because I will reveal one bonus company that also seems to be on sale. The first company on this list of companies on sale is Enbridge. If you were fortunate enough to have invested in Enbridge in March of 2020, you would already be looking at a yield on cost of almost 11%. That is crazy. Enbridge operates as an energy infrastructure company, which means they take care of transporting and storing different energy sources such as natural gas, crude oil and renewable energy. Enbridge transports about 25% of all crude oil produced in North America. There is a lot to love about this company: its predictable income stream, their wide moat and generous dividend increases. Looking at the price appreciation in the last 10 years and the payout ratio here on Seeking Alpha, it would be very easy to pass up on this company though. But stopping there would be a mistake. For pipeline companies like Enbridge, it is not prudent to look at the earnings payout ratio or free cash flow payout ratio, but rather at the distributable cash flow or DCF payout ratio, and that ratio is around 70%. Still on the high side, but not the 127% we saw before. As a dividend growth investor, Enbridge looks very tempting with a yield of 7.5%, and they have actually just raised the dividend with 3%. Increases before that were a lot more juicy with 10% increases in the last 4 years though. It would be a mistake to blindly chase the yield. The question is, why is that yield so high? One of the most obvious reasons is the drive towards reducing carbon emissions worldwide. With over half of the company's revenue coming from crude oil transportation and storage, this is a risk to consider. The other short-term risk is the struggles they have with their Line 3 project. Using the dividend yield theory, it is obvious that Enbridge is undervalued with a current yield of around 7.5%, whereas the 5-year average yield is at 5.5%. This is definitely an interesting company to look into further. The second company is a completely different company.
At Lockheed Martin, we're on a mission. Your mission. Not just the next mission, but the one that's 2 steps ahead. The one that depends on solving problems before they happen. Our mission is to prepare you for the future.
Lockheed Martin is a global security and aerospace company and has 110,000 people working for them worldwide. LMT designs and produces advanced technology systems, products and services such as helicopters, military planes, missiles, satellites and space transportation. As a content maker, I love companies like these, because their products make for some awesome footage. Had you invested in Lockheed Martin in 2006, you would have turned your 10k into almost 65k for an annual growth rate of 13.5%, dwarfing the S&P 500. For the dividend growth investors out there, you would have a mouth-watering yield on cost of 13 to 14%. Lockheed Martin is well diversified and operates in 4 segments: aeronautics, missiles and fire control, rotary emission systems and space. I wonder who else is investing heavily in space. It is at the tip of my tongue. The thing about these defense companies is that they have quite a wide moat since their barrier to entry is high. In most sectors they either have a monopoly or a duopoly. The revenue has a nice uptrend. The net income is a bit more messy, but is also going up in the last few years. Debt to equity is on the high side, but coming down. As a dividend investor, I love the dividend profile of Lockheed Martin as well. These are exactly the kind of companies I look for. A 3+ current yield, and dividend increases in the 8 to 10% range, and a 40% payout ratio. The 10-year price gain is 313%. I ask you, what more do you want? I don't own Lockheed Martin, but I do own one of their peers, General Dynamics, with a similar dividend profile. I did a stock battle between General Dynamics and Raytheon Technologies in episode 28, which is now suggested in the top right. Some key risks with Lockheed Martin are its reliance on government spending and the reliance on one single product, the F-35 fighter jet. It doesn't have to be a problem, but just ask Boeing about the reliance on a single product and their 737 MAX saga. Lockheed is in this list because they are undervalued. So show me. On fast graphs we can see that the price line is below the fair value and the blue line. If LMT returns to the orange line, we could see a 17.1% annual return. You know what else is undervalued? At least according to my own measurements. The number of subscribers on this YouTube channel. So subscribe if you want to stay updated on future content. I'm Tom from the Dividend Attitude Show, and on this channel I make deep dive and lighter dividend stock analysis videos. In third place is a global biopharma company, and that is AbbVie. Among other things, they develop and market medicine and treatments for immunology, oncology, and virology. If you're like me and have to look up what those fields were about again, AbbVie focuses mostly on assisting patients with autoimmune diseases. In the immunology field, oncology is about cancer treatment and the focus in virology is on assisting patients with HIV, for example. Before, I was saying that Lockheed Martin has the perfect mix of dividend yield and dividend growth. AbbVie has an even better profile with a stunning yield of almost 5% and recent dividend raises of around 10%. The 5-year price performance shows an almost 100% gain. The big dark cloud hanging above AbbVie is the reliance on their blockbuster drug Humira, which will lose its patent in 2023 in the US. The Humira drug makes up a bit under half of its revenue, and in Europe, where Humira is already facing competition from similar medicine, the sales already went down quite a bit. And that is exactly why they acquired Allergen in 2020, which they call a transformative acquisition, which should help further diversify their drug portfolio. But enough with the doomsday talk. Because looking at the revenue trend, it is clear that they have a nice uptrend. In fact, their full year 2020 results were announced at the beginning of February, and that showed they have a 38% year-over-year increase in revenue to 46 billion. The net income trend shows some dips, so that is something to look into. If this is such a great company, then why is it not in my portfolio? Honestly, I have been and am still debating it, but the thing I personally don't like is their debt. It ballooned from 33 billion to 82 billion in a year because of the Allergen acquisition, and the debt to equity ratio was around 6 in the latest available information. Okay, but what about the valuation? Fastgraphs has AbbVie at 38% annual returns until the end of 2022 if they come back to the fair value, the orange line. Analysts are expecting double-digit growth for 2021 and 2022, and then a 13% decline in 2023 due to the expiring patent of Humira. And now the company in second place, which I think is one of the top picks in this undervalued list, and that is CVS Health. CVS describes itself as the premier health and innovation provider that strives to help people on their path to better health. Just look at the beautiful revenue uptrend. 2019 is the first full year where CVS operated as a merged company, and it shows. A 32% year-over-year increase. CVS has just released fiscal year 2020 earnings and showed a 4.5% increase in revenue and an 8.4% increase in net income year-over-year. The stock price did drop significantly because analysts expected better predictions for 2021. CVS has about 9,900 retail locations, 1,100 minute walk-in clinics, and is the leading pharmacy benefits manager with an astounding amount of 105 million members. CVS merged with Aetna at the end of 2018 in a $69 billion deal to form a new healthcare powerhouse. With this, CVS racked up a lot of debt, as you can see here in the debt to equity trend, and dividend increases were frozen to bring down leverage. They are aggressively paying down debt, so as a dividend growth investor, I hope they will start increasing their dividends again in 2022. They certainly have room to do that with a payout ratio of only 27%. I went over my reasons for holding CVS in my end-of-year portfolio review, which is now suggested in the top right corner. Fun fact, looking at the amount of YouTube videos about CVS hauls, it is apparently a thing to go to a CVS and get as much discounted stuff as possible. So now why I think CVS is at the top of this list. Fastgraph shows us that CVS is well below the orange and blue line. If CVS would return to fair value, the orange line, we could be seeing an almost 33% annual return. And if they start raising their dividends again, I don't think they will raise it with just a token raise of 2%. And I'm looking at you, AT&T. And then the company in first place. And that is the Bristol-Myers Squibb company. Bristol-Myers Squibb is a worldwide biopharma company that discovers, develops and delivers innovative medicine that helps patients prevail over serious diseases. If you had invested in BMY in August of 2006, you would now have a yield on cost of almost 10%. Your 10,000 investment would have turned into almost 43,000 with dividends reinvested, just beating the S&P 500. Very important for a biopharma company is their pipeline, so it is good to see that Bristol-Myers had several drugs approved in the fourth quarter of 2020. Acquisition of Celgene will help with that as well. And in 2020, Bristol-Myers completed another acquisition by acquiring MyoKardia. The sales of Bristol-Myers are uptrending in the last few years and had a big increase of 62% in 2020. This increase in revenue was mainly driven by the acquisition of Celgene in 2019. So why is the stock down? The biggest threat is that B&Y will lose exclusivity on 3 drugs that accounted for about 2/3 of the revenue in the first half of 2020, of which the first one, Revlimid, will already lose exclusivity in 2022. Bristol-Myers is severely undervalued and could return as much as 48% annually until the end of 2022 if they would return to fair value, and thereby deserving the first place on this list. But wait, there's more. There's actually one bonus company that could very well fit in this list of stocks that are on sale, that I did not want to keep from you. And that company would be Merck, which could return about 23% if it would return to fair value. In the bottom right is a playlist about battles between 2 comparable dividend stocks that you might like to watch as well. By clicking on the top right, you can enjoy in-depth videos of dividend stocks. And in the top left is a video that YouTube thinks you might like as well. I'm off.